Hey everybody, welcome to the Free Toaster News Pod. Every Friday we cover one story, and this week it's going to be two at the intersection of consumer lending, marketing, and technology. These stories come from our Wednesday newsletter, which we publish at thefreetoaster.com. Today, we're going to discuss the Cash App Borrow story that we covered several weeks ago in our newsletter. Before we get to that story, I want to pause to thank our sponsors, Spinwheel, Bulldog Media Group, and Fintech Connect. The headline we reported on was that 70% of Cash App Borrow customers have a credit score below 580, and yet the product maintains a 97% repayment rate. One of our readers and industry friends, Prabhu, who's here with us today, correctly pointed out that those short-term loan metrics are difficult to compare against longer-term loans like credit cards and personal loans. Prithvi is currently the Chief Analytics and Risk Officer at Quantum Lending Solutions. Earlier in his career, Prithvi was a leader in both the consumer and small business lending organizations at Capital One. Later, he went on to run product and risk at Avant. So Prithvi, what context should we have added to that story when we initially reported it?
First of all, Carlos and Nick, thanks for having me on. It's quite exciting. The very first podcast I'm on. Yeah, so the reason I think that article and your response also struck a nerve in me is because I've seen this happen on multiple occasions, right? Where, I mean, again, Block is doing, their PR is doing what it's doing, which is, hey, look at us, average FICO of 580, and we have repayment rate of 97%, right? So that sounds great. But if you take a look at it closer, then you realize that product is meant for repayment over a period of weeks. Right? So their particular metric is looking at repayment rates over a 3-week period. Right? Not only can't you you can't compare this to like a longer term loan, like credit cards or even term loans and so on. Even if you look at other payday lenders or cash advance products in the market, like for example Dave, 97% repayment rate honestly is fairly run-of-the-mill for that kind of product, for that kind of segment, and so on. Again, FICO 580, 97% repayment just sounds great until you look a little bit closer.
If you had to give us a comparable benchmark, say in the card industry, is that 97 repayment rate, like how would you benchmark that from a risk level to, like if you were to compare it to like a 12-month charge-off rate or something like that? Like
yeah,
what? Do you have any mental calibrations on how to map a data point like the 97% to a metric our audience might be more familiar with?
Yeah, absolutely. I mean, so if you take a look at, let's say, like any of the transactor cards and so on, right, out in the market, if you think about the Venture card or the Amex Platinum and so on and so forth, right, they would have repayment rates over a period of a year of at least 99% and so on. The economics don't work if they have 1% failure rates over a 12-month period. Right? Now, in Block's case, given it is a cash advance product and given their pricing, even with a 3% failure rate over 3 weeks, they make money hand over fist. Right? So just like a typical payday loan, right? So I think that's the context. The duration of the product really matters in these cases.
Got it. The other theme, and you hinted at it earlier on like a fairly run-of-the-mill repayment rate. But if you unpack the press release further, you start to notice that they're selling a FICO-like score that just signals very clearly they're building a B2B business alongside the B2C business, presumably to help lenders underwrite with the signals they have, the cash flow they have, the transactions they have. What's your take there? Do you think that they're positioned to help, say, a run-of-the-mill credit card issuer or personal loan provider with something like this?
Yeah, honestly, I'm a bit skeptical, and I would even go as far as to say that it's a bit dangerous, right, for lenders. And I'll tell you why. So I read the press release, and they did show that they want to expand access to credit, and they've tested out the Cash App score on other products and so on, right? So I think the sentiment is good, right? They do want to enable usage of alternate products and so on, which I think is good from that perspective. However, again, comparing it to a FICO is like I said, apples and oranges, right? Like the Cash App score is built to look at short-term risk, specifically over a period of 3, maybe 6 weeks or something of that sort. FICO is looking at risk over an 18-month period, right? They did mention in the press release that they believe that they can approve 30% more auto loans at identical loss rates compared to quote unquote conventional methods. What I don't know and what's not mentioned in the release is at what point are they measuring these loss rates? Are they measuring it after 1 month, 6 months, 1 year, 3 years? It's not very clear, right? And the danger in this is like I've seen this movie played before, right? I've seen a lender which started out doing payday lending and high risk short term lending. They built the entire model that way. And then they decided to offer 3 and 5 year term loans on the back of that model. So if you think about, if you're a lender that starts using the Cash App score, here's what you're going to see. You're going to see your early results are going to come in great. It's going to beat FICO in the early days, right? Risk is going to be lower, and as a lender, you start saying, "Hey, this is great. Let me double down on this," right? So you do even more volume, and 9 months later, the real long-term risk signals tick up, and by that time, you've booked 6 or 9 months of loans, which is going to lead to a world of pain for that lender. So again, I mean, I think you need, like any lender that is thinking of using the Cash App score needs to be very, very careful about how they test it out and how they use it. Because again, if it's used in conjunction with other tools as an add-on, sure, I think it can help out. But that doesn't really help with Block's aim, the stated aim of increasing access to credit and so on. Right? It's actually dangerous for risky borrowers to be given loans which they can't afford, because it just gets them further into debt. It's the exact opposite of what Block seems to.
Continuing on this theme of like outside data, what alternative data sources are you paying attention to? There's been a lot of hype probably in the last 12 to 18 months on cash flow. I see a post a day at least on LinkedIn about something going on with cash flow. The truth of like the practicalities of the lending world that I live in is cash flow is a use case in second look programs and deep subprime use cases where, traditional FICOs and credit bureau data like just fail to have good coverage. So it's very, very niche in my view. But I have a narrow view on the world. I work with a few lender clients. I'm curious your take, just A, maybe just cash flow underwriting in general, your thoughts, and B, are there other categories of alternative data you're paying attention to?
Absolutely. So Quantum, where I'm currently, is a small business lender. And in small business, cash flow is key, right? That is used in underwriting pretty much like any type of underwriting you do, that is king.
And that's been the way for years, right? Decades.
It's been the way for years, absolutely. Yeah. In the consumer space, you're right. It is far more niche, mostly because traditional consumer bureaus do a pretty great job, honestly. And I think, even though I'm an underwriting person, I recognize the power of marketing, right? Because I think what people don't fully realize is the power in underwriting is like the reason credit bureaus do so well is because they have this magic bullet called pre-screen. You can target who you want to approve, right? And that's just not possible with cash flows, right? And I think that's the reason why like cash flow scores in consumer will always be ancillary in my opinion, because you can't target people who you're likely to approve.
Well, there's that, which I think you nailed, and that becomes relevant in like a direct mail context, something like that, or even like an affiliate marketing channel. The other challenge I've had or I've seen issuers struggle with is, I've seen countless lift charts that show me the sloping, even incremental to credit bureau data when you incorporate cash flow. There's always incrementality. The problem is at what cost? Because like you're introducing this friction in your application flow of either upload a bunch of statements or more practically give me credentials to your checking account through Plaid, which scares the crap out of most consumers.
Yeah, absolutely.
And it actually tends to scare the borrowers you want to move through disproportionate. Like the risky guys are going to do anything you ask them to do, right? It's the borrowers that you want that are going to get a little bit nervous handing over the keys to the checking account. So there's like a negative select dynamic, and there's a just drop off dynamic in the funnel. So that combined with what you just said on pre-screen makes me feel like cash flow is going to be niche until they solve both of those problems, which maybe open banking can solve one day. But I don't know. Do you think there's a path to solving that problem anytime soon?
I mean, people are getting more and more used to providing the credentials. Right? It is becoming easier. I think there's more customer acceptance. But you're absolutely right. Like I've done credit cards and personal loans in the past, and for a subprime credit card or even a near prime credit card, $5,000, honestly, that's too much friction. Whereas if you're doing a personal loan product and you need to make a $30,000 loan decision, at that point, the marginal benefit is worth it, right? So you do need to verify income in some cases, so you might as well get cash flow along the way and do it.
Totally. And in the context of a $200,000 line of credit and for a small business, like, yes, absolutely. Yeah, if you need to see my transactions, like I get it because it's a big enough deal. Anything else in kind of the tech or underwriting category you're particularly excited about or following? We're always looking ideas for what stories to cover or what. I know you're a reader of the Toaster, so it's always good to hear feedback on categories you're paying attention to.
On alternate data, it's mostly the device information, which is pretty interesting, but it's more useful from a fraud perspective. Internationally, all of that information comes into play, but in the US, I think, given the regulations, it's a little bit more. It's not easy for lenders to use that, except for fraud. But there's a lot of interesting work happening there. There are a number of different niches, but in cash flow, again, I think as an underwriting geek, I mean, there's lots to do in cash flow. Whether it has a lot of views, that is a different story. But there's a lot of interesting information that comes out of it.
One follow-up, and then I want to plant a seed in your brain. But the first one is, when you think about Cash App's behavioral data, I'm assuming it's largely been generated in a relatively stable or tight labor market. Like when FICO has probably been battle tested through the cycles of multiple recessions. Like, how should I think about understanding that a bit better?
Yeah, that's fair, because it's not just the labor market, but also Cash App's usage has grown over time, right? So the question is, how representative is their experience over a particular customer base, right? I mean, with an average FICO of 580, they're targeting a particular customer base, right? Whereas I would assume Chime, for example, has a different customer profile, and of course the Chasers of the world have a very different customer profile, right? And I think going back to the modeling piece, duration matters, but so does population, right? The signals that you get from using Cash App with a FICO 580 kind of population is very different than the signals that you'll get with a FICO, let's say 760 kind of population, right? You cannot translate it very easily there. And Nick, to your point, the Cash App experience is over a fairly limited time period. There has been, of course, the pandemic and there's the inflation-based, the K-shaped recession. So they have some experience in these kind of environments, but a true recession, Cash App hasn't really seen.
Nick, this week we covered as our second story in the weekly news, Mr. Beast. It was announced that he acquired Step. It's a banking app that provides, and I'm reading here from the press release, credit building and money management tools for younger users. By integrating Step into his ecosystem of 466 million subscribers, the company is testing whether influencer reach can convert fans into long-term banking customers. So look, I'm not surprised to see this. I've seen Mr. Beast. He's already collaborated with MoneyLion, so this is not his first foray in financial services. Presumably that partnership went well, and now he started thinking, well, my economics get way better if I not only promote the product, but if I own the service end to end. We've seen him do this we were talking earlier about like consumer goods. I think it was Feastables that you mentioned, Nick, when we were discussing earlier. He's not a newbie to a fully integrated model where he owns distribution and then like the whole product and fulfillment underneath it. So my take, Nick, is he's not going to have any problem drumming up customers for the Step app. Like that's his superpower, is distribution and attention. But does he know how to run a bank? Does he know how to run a lending business? Does he understand what the hell he's signing up for? Like that would be my question. It's possible he has a Class A management team already underneath him. That is possible. I think it's more likely than not he's going to mishire or he's going to screw something fundamental up in delivery. I personally, if I were him, I would be sticking to partnerships for a while. But anyways, Nick, what's your take here? I know you've been reading
so
about this too.
confused. I'm trying to wrap my head. I just saw Mr. Beast at the Super Bowl. He had a commercial with Slack. And then I think you and I are doing the wrong thing, just to be clear, with our portfolio business, because it says the company's cash cow is the chocolate brand Feastables, which is more profitable than both Mr. Beast YouTube, his channel, and the Prime Video show Beast Games. First of all, why are we not doing chocolate as like my number one? Maybe we're missing the ball here. But it reminded me, this was years ago. I don't know if you know, but Mr. Beast has a partnership with Current, the Fintech.
Oh, I didn't know that actually.
This was done. Maybe like it's how I learned about Mr. Beast. To be clear, maybe 5-6 years ago, and like you got like $1 when you did something to Mr. Beast. But I just have to imagine like he's kind of already done this fintech promotion kind of thing. This is a different ballgame, to be clear. But I'm with you. It's just like running a fintech is fundamentally different. If you're also running all these other things, like how do you even manage that? I don't get it. Is my TLDR.
I mean, look, this reminds me that this was like ancient history, so I'm even having a hard time recalling the detail. But Susie Orman, like big personal finance guru, I think good personal brand in the category. I think she tried to launch a credit card, something like that. It was a disaster. It was an absolute disaster. NerdWallet's tried it, disaster. Lending Trees tried it. Like, so I've seen this playbook before where people who command attention or entities that command attention in consumer finance make a bet and say, hey, I'm going to provide the product as well. It's just such a different game. It's such a different animal to running what they were good at. In Susie's case, it was content. In NerdWallet's case, it was publishing and matchmaking products. Same with Lending Tree. Look, I actually think it's possible for someone like Mr. Beast to do this right. I think what outsiders perceive as lending money, it seems simple. Lend it at 20%, borrow it at 5%, make money in between. But then there's just a host of issues with fraud and credit risk and capital markets. There's a gazillion ways to break a lending business.
So you talked about how like this creator-led businesses, like you think it's unpenetrated. I think you've mentioned before. But B, what is the playbook to make that work well? And like, I obviously we're biased. I think we're doing it in the right way, where the content we're creating is very close to the businesses we're creating, right? But when you have Mr. Beast blowing up some bank on set, I think it's in North Carolina, I'm not exactly sure. Like, how does that tie back to a fintech for 13-year-olds? Like, I don't get it.
I don't know. I haven't seen I don't know if he has financial content. If he doesn't, he probably should, because you're right. If your content has nothing to do with the products you provide, I think you have a problem right out of the gate. I mean, one thing comes to mind for me. I think it's just something I've been discussing with clients lately, and fintechs feel this, is their distribution is very concentrated these days with affiliate marketing and direct mail. Those are like the two major categories I see. Underpenetrated in search, underpenetrated in social. And if I were a fintech, I would not try to be making videos and doing paid ads on Facebook. That's not the skill set a bank generally has on the creative side. I would be finding influencers that already have reach and trust in the audience I'm trying to land. I would just be partnering. I would be finding mini Mr. Beasts all over the place, 100 of them that are much smaller, but very niche and dialed into consumer finance, and having them promote my product on my behalf. That's what I would be looking to do. So that I'm surprised more lenders aren't running this play. When I talk to lenders about this, the hang up is compliance is the big one. They're worried the influencer is going to do or say something in a video or in a podcast that misrepresents the product or deceives someone intentionally or unintentionally. The regs do not care if you are intentional or unintentional, and UDAP is the name of the law. Like unfair and deceptive acts and practices is the law. And lenders are just very, very nervous that they're going to get caught up in class action lawsuits because a influencer said X, Y, and Z about their product, which the product doesn't actually, in fact, deliver. With AI, you can create your guardrails, you can manage the content, you can create a way to have the influencer present the content before it goes. I just feel like with the technology we have in 2026, this should be solved. But I still hear from every lender I talk to, that's the reason they're not leaning in more aggressively. Maybe Mr. Beast being more vocal around entering here is going to relax or change some people's minds. I don't know. Or maybe they'll double down and just think this is just an area I want to stay out of.
Yeah, I think in 6 months from now, I may be making you have a persona called Mr. Carlos, and we're going to start by blowing stuff up. And then we're just going to push all the businesses we do. That's 6 months from now. Somebody hold me accountable. I'm going to make you do that. We'll see what happens. If he's right about this, then we're doing that.
And then we'll sign a deal with Safeway or
Done.
Giant to sell some cookies.
Done. Oh no, we need chocolate, right? Sorry, yeah, we got to.
Was it chocolate or cookies?
It was chocolate. It was that's what the article said. So.
Well, when I was at Safeway a couple of weeks ago, I saw the cookies, the Feastable cookies.
Okay.
So it's not just chocolate. Yeah, I guess we'll see you next week, Nick.
Thanks, Carlos.
All right.